So what we're going to talk about today is briefly the fixed income dilemma. All of you on the phone know what the dilemma is, and we'll just go through the key points of the dilemma and more importantly, what the solution to the dilemma is, because we think we have a pretty good solution here in this fund, which implements what I call DGARP. DGARP is dividend growth at a reasonable price. Everyone's heard of GARP, growth at a reasonable price. What we do is dividend growth at a reasonable price. We'll dive into the fund itself, talk briefly about the characteristics of the fund, and then we'll look at the portfolio a bit. I'll take a quick digression and look at value versus growth, the styles that have been bouncing around quite a bit lately. Growth is in a bubble relative to value, and we'll talk briefly about that and why it's important. And again, we'll dive right into the questions after that. So the fixed income dilemma. First, I had a couple cartoons that Marco had found that I thought were quite appropriate. And then the first cartoon says, if we take a late retirement and an early death, we just might squeak by. That's quite appropriate with the Canadian 10-year bond yield right now. Even though it's up 4 basis points today, it's only at 1.2, and the US 10-year bond yield is at 1.28. So yeah, it's a tough world for retirees. And then the second cartoon says, I'm just saying, if our income is fixed, how come we're so broke? And again, we think the fund, the growing income fund that we'll talk about today, solves these two problems. So what is the dilemma? The first one is that most people's planning horizon is much longer than they think. So lots of older folks that you might talk to, 60-year-olds, 65-year-olds, 70-year-olds, might be thinking in terms of 5-10 years. The reality is current Canadians live a lot longer than they think they do, number one. And number two, you can't plan for the median expected death. So if you say the average Canadian female at 40 years old today in Canada lives to 86, which is the truth, they live to 86 on average, that's a 50-50 probability. What you really have to do is think in terms of 1 in 5, 1 in 10, and make sure that they don't run out of money or income before they actually do die. So for example, with using the current life tables from StatsCan, 1 in 10 Canadian females that are currently 40, that have made it to 40, live to at least 97 years old. And even us males who don't make it quite as long, we live to at least 94 years old. So if you're 40, you're thinking in terms of 5 decades. If you're 60, you're thinking in terms of 4 decades. So your planning horizon is very, very long. Now, the problem with having decades of life left, I mean, it's great if, that we're going to live so long, but the problem is inflation. Inflation is the enemy to all people entering retirement, especially if it's going to last for 20, 30, 40, possibly 50 years. Inflation chews away at the income, the purchasing power of the income that they're receiving. It also chews away at capital. So the purchasing power of what you can buy, oops, I'm going the wrong way here, sorry. The purchasing power of what you can buy goes down as time goes on, as inflation chews it away. And of course, inflation is a big topic of discussion now. Many people believe that we're going into a higher inflation time period. The last 30 years in Canada has been 2.5% inflation. The Fed, until recently, is targeting 2% inflation. They were hoping for just under 2%. So think in terms of 2 to 3% inflation, and possibly higher if some of the fears come true. I do believe, by the way, I think Canada's inflation rate was announced this morning, 4.1% year over year. So much higher than the 2% target, possibly, drifting long-term, maybe it's 2.5. But I do believe that a lot of the 4 in Canada and a lot of the 5 in the US is transitory. So meaning it's base effects and supply chain issues, both of which will resolve themselves in the quarters to come. Having said that, you do have to think in terms of 2 to 3%, especially if you're an older person. Older people face higher inflation rates than the CPI typically shows us. And of course, interest rates and dividend yields out there are lower than they've ever been before. Again, the Canadian government 10-year bond is 1.2%. The US 10-year 1.3%. The universal bond, bond index, even when you put in longer term stuff and corporates, yesterday was 2.5% yield. S&P 500, its dividend yield is amongst the lowest in history at 1.3%. A lot of people don't realize that S&P 500 stocks on average are generating 1.3% on average in dividends right now. And the Morgan Stanley World Index, the whole world combined by market cap, 1.7%. Virtually all those numbers I just listed off are less than inflation. Inflation is well above 2% right now, and even in the long run, you're looking at 2 to 3%. So inflation is the enemy, and against a backdrop of ultra low yields, that presents a really, really big problem for investors. So what's the solution? The solution, we believe, is growing income. Growing income allows your income to grow through time by definition. The whole idea is to find an income stream that starts at a certain level and then goes up every single year. Just as inflation is chewing up part of that income every year, we want to counteract it with growth. And it turns out mathematically, for a fact, if income can grow, so must capital as well. So that capital pool that you start with, if you start with $1 million, the purchasing power of $1 million, if it's not gaining in returns, in capital returns, of course goes down with inflation as the years go by. And even at 2% inflation, 40% of the value, the purchasing power of that capital and your income is gone after 25 years. So in order to counteract that as well, you want income to grow, which induces the capital to grow at the same rate. Okay? So we believe that the only solution for the current fixed income dilemma is growing income. Now, if you think about it, where can I get growing income? There's actually only two asset classes in the world that produce growing income. First is real estate. Real estate rents tend to go up with inflation, so your income goes up with at least inflation. And because the rents are going up with at least inflation, the price of your real estate tends to go up a little bit faster than inflation as well. But that is the only way that you can produce the growing income, which in turn generates growing capital. The second asset class where it happens, which is what we do, is growing dividend stocks. Equities that grow their dividends through time. The dividends that are spit off go up through time if you pick those securities properly. And if those dividends go up through time, almost by definition, so must the price of those stocks. Capital and income going up with the growth rate. Okay? And this, by the way, is math. It is not a theory. It is not conjecture. It is literally just math. So how do we do it? We take an approach that's summarized in the acronym DGARP, dividend growth at a reasonable price. I'm not going to dive too deep into it today. I just want to give you the basic outline of the way we think about dividend growth. The fundamental problem with dividend growth is that there's a trade-off between yield and growth of that yield or growth of the dividends. You will not find out in the free market, the capital markets, a stock that, for example, pays an 8% yield and grows at 10% per annum. They just don't exist. What the market will do with that 10% growing company is they'll bid the price up and the yield back down. So you may find a 3% stock, yielding stock that grows 10%, but I can tell you, you won't find an 8% stock growing its dividend at 10% per annum over the long run. They just don't exist because price has to go up to drive that yield down. So how do we look at stocks that, a stock that pays 1.5% like a Lowe's or a fast-growing, lower yielding stock to an Enbridge, for example? We need a way to put the combination of growth and the magnitude of the yield together. And we've come up with this concept called the SIVAS GDI score, growth of dividend income score. And it basically just takes the yield and multiplies it by the dividend growth rate. So if you have a 4% yield and a 10% dividend growth rate, 4 times 10 is 40. Simple as that. And what it does is it allows you to compare low yielding stocks to high yielding stocks, adjusting for the fact that you can't expect a high yielding stock to have a high growth rate, but you better expect a low yielding stock to have a high growth rate, at least in our view of the world. So let's take some examples here. So Enbridge, it's a 6.7% yielding stock, and it's growing its dividend, I think on a forward-looking basis, around 6%. Historically, it's been closer to 10%. This is a dividend growth champion. It's got great yield and decent growth. So if you take 6.7 multiplied by 6, you get 40.2. Broadcom, the old Avago, that's why the ticker is AVGO. It's a US American tech conglomerate. They have a current yield of 2.9%, and I expect dividend growth north of 10% per annum. Let's call it 14% per annum. Historically, it's been significantly higher than that. So 2.9 times 14, 40.6. Another great dividend growth stock. The combination of yield and growth generates a terrific portfolio position for us. And in fact, Broadcom is in the top 3 of the portfolio. And what you notice too, by the way, Enbridge 6.7% yield, Broadcom 2.9. I'm comparing 2 very, very different yield levels on stocks, and they produce about the same GDI score. So they're equal in terms of everything else being equal. In our view of the world of dividend combined with growth, we view them as similar positions. Manulife, 4.6% yield. Let's call it an 8% forward-looking dividend growth rate. 36, great stock. One of my favorites in Canada. In fact, probably my favorite in Canada. Prudential, another insurance company, but from the US, similar characteristics. Similar yield, 4.3, similar growth rate, 34 overall GDI score. Terrific position in our view of the world. Lowe's, the lowest dividend yield on here, 1.6%. Why is a high yielding fund buying a 1.6% stock? Because it's growing its dividend at 20% per annum consistent. So 20 times 1.6, 32. Great stock in our view of the world. So very, very good. So all these positions are in the portfolio, and they're in the portfolio because of this yield growth combination being so attractive. Now let's look at some very typical dividend positions, some of which are dividend aristocrats, and many of which we've owned in the past, but do not own currently. Procter & Gamble, 2.5% yield, let's call it 7% being generous growth rate, 16.8, not nearly as good as the prior stocks. J&J, awesome company, terrific company, just like Procter & Gamble, 2.5% yield, dividend aristocrat, increasing its dividend for 50 plus years, 6% yield though, or sorry, 6% growth, 15, 2.5 times 6, 15. Southern Company, a large utility company in the US, 4% yield, very popular amongst dividend managers, but only 3.5% dividend growth yield, dividend growth rate, 14 in total in the GDI score. Microsoft was one of my most profitable positions in the mid 2015 through 2018. But now it's 0.8% yield, believe it or not, and 10% dividend growth rate. That's only 8. Apple, 0.6% yield right now. Only an 8% dividend growth rate, believe it or not. They have the ability to grow it much faster, but they're not doing it. They're buying back shares instead. 4.8 on the GDI score. We don't own any of those because of those reasons. The yield growth combination just isn't solid enough relative to the Manulifes and the Broadcoms of the world. So that's the basic way we look at stocks. Now we consider many, many other factors. It's a traditional process. This is not a quantitative process, but what this GDI score does for us is it takes the world, 4,000 or 5,000 stocks and takes us down to, believe it or not, in the 250 range. There's only about 250 stocks that have GDI scores that are attractive enough for us to even consider investing in. So that's what allows us at a small firm to take the world, the globe, and shove it down to a manageable universe. We're looking for high yield growth combinations as judged by the GDI score. Okay. And then amongst these 250 global contenders, let's say, then we look at traditionally at what the companies are doing, earnings growth rates, what the analysts think, the whole slew of everything you can imagine that a CFA would look at. Okay? So it is a traditionally managed process. We use the GDI score to get our universe down to a manageable size for a small firm so that we can look in detail at these companies. So the fund, we have three primary investment objectives. The first is consistent and well above average distribution yield of the fund itself. This is an income fund. It is a replacement, believe it or not, for fixed income. We are solving the fixed income dilemma. We want to deliver a yield that is right now much, much higher than fixed income. The distribution yield out of the fund is well over 3%. We also want dividend per share or distributions per share of the fund to grow through time. The key again is we want this dividends or income to grow faster than the inflation rate. If it's growing faster than the inflation rate, then the purchasing power of that income will be maintained because it's better than inflation throughout a person's life. This is a forever strategy as a result. The idea is buy it, live off of it, and your income will go up at least as fast as inflation, and ultimately capital will go up with growth. So our third objective, of course, is long-term appreciation of capital. We believe that, and we do this in order. So the investment objectives are stated in the order of priority. Have to have a decent yield. Never have we been below 3% yield at the fund level. Typically, our average dividend yields are in the high threes. We have to have growth of income is the next highest priority. And we actually believe that the third objective, long-term capital appreciation, is a consequence of delivering the first two objectives. If we deliver a decent yield that grows nicely through time, capital appreciation is a consequence of this package together. I don't have to focus on looking for the highest returning stocks. All I have to focus on is good yield that grows through time. Then capital appreciation mathematically is going to be delivered sooner or later. We get the dividends right, we will get the share prices right. And this is kind of the proof in the pudding, if you will. This is Series F distributions out of the fund on a calendar year basis from the inception of the fund, which was back in early 2015, until now. And what you see here is every year, you're seeing this escalating distribution per share at the fund level. Exactly what we wanted to do. And you'll notice that the current trailing distribution yield, despite being up over 40% in the last 12 months, this trailing distribution yield is 3.3% on an annualized basis. And you'll see that since inception, our distribution has grown by 8% per annum. Inflation, 2-3. We are maintaining an investor's lifestyle and we'll be able to do it forever. And in fact, they're getting a raise every year, even after taking off inflation. A significant raise, a 5% raise above a 3% inflation rate. So that's the way we look at the world. We're trying to deliver investors an ever increasing distribution per share, and hopefully that is significantly ahead of the inflation rate. Therefore, the clients are getting a raise every year. Their purchasing power, their ability to spend money goes up every single year. You'll notice a little dip last year. We had what I call the dividend Armageddon during COVID. Fully 20%, 1 in 5 of all large cap North American stocks actually cut, suspended, or eliminated their dividend last year. We are seeing dividend growth reaccelerate at a very fast rate right now. So what you see right now is 2021's distribution is annualizing right now through the end of August we're back on track. You can almost ignore 2020, and we are well ahead of our distribution that we paid out on 2019. Bang on mandate. A couple more points on distributions. We pay monthly, and we pay only the amount of income that the fund receives. Every penny that the fund, after withholding taxes, receives in income from dividends around the world, every single month I go to the penny, and that's what we distribute. So every month the distribution does change because it's exact to what we received, but what you see over time is this growth. Okay? What this is then is a real measure of distributions. It's a real measure of true income generation by the stocks that we hold in the portfolio. This is very unlike most dividend funds in this country that pay out a fixed distribution yield, typically set much higher than they're actually earning. So this is true income. As a result, there's no NAV grind. There's no NAV per unit grind like you would see in a fund that, say, earns 3.5 but's paying 5. There, you're driving down the NAV because you're not paying out income. You're paying out income plus part of the original capital that the person put in. Currently, we also have a very unique situation in the fact that this fund is a corporate class fund. The corporate class funds, as you know, can share gains and losses from other corporate classes. We took over this fund, this corporate class, from a flow-through rollover fund, which was kind enough for us to generate a substantial tax loss carry forward, both in capital gains and in income. And if you think about what I do as a global dividend investor, the majority of my dividends come from the US. More than 50% come from the US. And as you know, US dividends are treated as income in Canada, as opposed to capital gains, of course, or dividend credit eligible Canadian dividends. So it's treated as income, but we have all this income losses. So we're able to net those against each other every year. And in fact, since inception of the fund 6 years ago, no investor T5 split has shown any income gains, and in fact, no capital gains either, because we also have $10 million of capital losses carried forward as well in the fund. So despite going up and paying out all these distributions, mainly generated from the US, no investor has received income or capital gains on their T5s. They've only received Canadian credit eligible dividends. We do distribute through the full system Canadian dividends because they attract a tax credit and because it's a corporate class fund. The portfolio, I list the top 30 on this slide. I won't go through them, of course, but I'll maybe talk about the averages. So it is a large cap strategy. We have $115 billion average market cap. We go down to $2 billion in size. So you can see in here, Fiera Capital's a holding in the fund. It's only a little over $1 billion. Aecon here in Canada is also a little over $1 billion in size. So we do go down to $1 to $2 billion, but on average, we are a very large cap fund. The average dividend yield in the strategy of the stocks that we hold before withholding taxes is 3.9%. So very high yield. But interestingly, and this is the key, you will not find this anywhere else in Canada, the average dividend growth rate, even though we've come out of dividend Armageddon, is 20.5% year over year on a 1-year basis. And in fact, it's 17.4% per annum. This isn't 5-year number. This is a per annum over 5 years. Our overall portfolio weighted 5-year dividend per share growth rate is actually 17%. GDI score comes in at a solid 29. And what you see here is it's an incredibly inexpensive portfolio. The average PE of our portfolio stocks is 12. The average price to cash flow is 8 on a forward-looking basis. That gives us incredible dividend coverage as well. We have 2 to 3 times coverage on our dividends. So high degree of dividend safety, and yet a nicely cheap portfolio with an incredibly high active share. 93%. We're 93% different than the Morgan Stanley World Index. Only 7% of our positions overlap. So as a result, the fund is a big time diversifier to your other holdings in the portfolio. Okay. I have portfolio exposures here. I won't bore you with them right now. Style, as I already indicated, we are heavy duty, large cap value. We're one of the few hardcore value strategies in the country, despite being such high yield. And it's because of our process. It's because of this idea of high yield with high dividend safety, with good growth. And what you do see is exactly that on our portfolio financials. Dividend yield is, what's that? 2.5, 3 times what the world index is. PE ratio is less than half. This is from Morningstar. All our other valuation characteristics are a fraction of the global index, but we don't give up growth because it's DGARP. We need forward-looking growth to keep up the dividend growth rate. So cheap portfolio, high yield, without sacrificing growth. And what you see is no style drift on those key characteristics. This is a 5-year style graph for Morningstar. Value, we're always high value through thick and thin. And we're always high yield through thick and thin. No style drift. Growth versus value, we do have a bubble. We are in a bubble, and I can show you this a million different ways, and I can measure it in a million different ways as well. There is virtually no measure out there that doesn't show that this is the largest growth bubble in history, even bigger than the tech bubble that occurred in the late 90s, early 2000s. This is a graph of the Russell 1000 large cap value index versus the Russell 1000 large cap growth index. These two indexes sum to the Russell 1000 index, so the whole US market. And all it's done is taken 50% and classified it as value, 50% classified as growth. So that's why I like it. It's not concentrated value or concentrated growth. It just takes the world and divides it in half. What you see here is the red line, the growth index, has outperformed the value index over the last 4 years since, actually four and a half years, since January 1st, 2017, by 132%. Imagine that. Segmenting the market in the US by 50-50, 150% half is up 175%, the other 50% half is only up by 40%. 132% spread. And this isn't just the recent phenomenon. The bubble was in place before COVID started. COVID just turbocharged the bubble. So if I go back all the way, say to the middle of the Great Recession, here I think it's, end of December 2008, the spread is actually 462%. This is a bubble. This bubble will end. And by definition, I don't know when, because by definition, a bubble is unforecastable in terms of when it ends. If you could forecast it, it's not a bubble. So all I can tell you is it will end. I just can't tell you when. So the reason I showed you that, of course, is because you remember the fact that we have extreme value exposure in the fund, and the day-to-day performance, the week-to-week performance of the fund, even the year-to-year performance, is highly correlated to what value versus growth is doing. So when, hopefully not if, but when value turns relative to growth, you should see capital outperformance in this fund, even though that's not necessarily my core objective. My core objective is, again, income and growth of that income.